Welcome back to our channel. Today we are explaining the demand curve for foreign exchange for Class 12 Economics.
This topic is extremely important for CBSE, ICSE, and state board exams.
In economics, foreign exchange means foreign currency, like US dollars. People in a country demand foreign currency for various international payments.
The first reason is to import goods and services from abroad, like oil, electronics, and education.
People also need foreign currency to send gifts or remittances to relatives living abroad.
Another reason is investing or lending abroad, such as buying foreign shares or bonds.
Foreign currency is also demanded to repay international loans and pay interest.
Some traders demand foreign exchange for speculation, expecting currency value to change.
The demand curve slopes downward because there is an inverse relationship between the exchange rate and the quantity of foreign exchange demanded.
The exchange rate is the price of foreign currency, usually written as rupees per dollar.
When the exchange rate increases, meaning the rupee depreciates, foreign goods become costlier.
When imports fall, the demand for foreign exchange also decreases.
The demand curve for foreign exchange is drawn downward from left to right.
As imports become expensive, people reduce their consumption of foreign goods.
The vertical axis represents the exchange rate, and the horizontal axis shows the quantity of foreign currency demanded. The demand curve shifts when factors other than the exchange rate change.
An increase in imports or more foreign travel causes a rightward shift in the demand curve.
Higher capital outflow, or more money sent abroad, also increases the demand for foreign exchange.
A leftward shift happens when imports fall, or people travel abroad less.
Capital inflow, such as more foreign investment in India, also reduces the demand for foreign exchange.
Remember that demand for foreign exchange is a derived demand because it depends on the demand for foreign goods and services. The demand curve is usually inelastic because essential imports like oil and medicine cannot be avoided.
A rise in imports or capital outflow shifts the demand curve rightward, putting pressure on the rupee to depreciate.
In simple words, the demand curve for foreign exchange slopes downward because a weak domestic currency makes imports expensive.
This concept is crucial to understanding how exchange rates are determined in an open economy.
Thanks for watching, and all the best for your Class 12 board exams.